Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. There's more economic pressure coming from the White House and President Trump's global trade war with an announcement of fresh tariffs on goods from Japan and South Korea. Plus, the United States is close to finalizing several trade pacts and will notify the other countries of higher tariff rates by July 9th. And investors are reacting. There's just 1 hour to go until the closing bell, and right now stocks are sinking. Let's welcome in now our ensemble. We have the great Adam Johnson, portfolio manager for the Bullseye American Ingenuity Fund. We got our Washington correspondent, that would be Ben Werschel, and senior reporter Ali Canal joining us to break down all the latest headlines. Ben, get us up to speed there in Washington.
Yeah, sure, Josh. So we've got a flurry of letters from Trump this afternoon and this morning outlining sort of his plan to dictate tariff rates on a lot of different countries. Here's the headlines. The two biggest ones are South Korea and Japan. Those are both in for 25% tariff rates. Others are 25% on Malaysia and Kazakhstan, 30% on South Africa, 40% on Laos and Myanmar. The key takeaway here, I think, from all these is how closely these track what Trump announced way back in April. That famous chart that he held up. Japan and South Korea, for example, are nearly identical. I think Japan had 24%, and it's now 25% on that chart. So we're very close on that. There's a few with a little bit more changes, but we're basically re-upping some of those rates that Trump had talked about months ago. The other key detail here, and the major change we've seen this afternoon, is a shifting of the deadline. Trump has been talking about this for a couple days, but it's been formalized that he's going to sign an executive order that changes the reciprocal deadline from this week, from July 8th to August 1st. So basically a 90-day pause adds about 3 weeks to it. So that's raising questions about exactly what will actually go into effect on August 1st, because it won't be going into effect this week, but it's clearly big numbers here with underlining Trump's desire to kind of go big on tariffs.
And Ben, listen, investors have a lot of questions. They're watching these headlines, right, coming fast and furious. One question would be, of course, what does this all mean potentially for growth? What are the possible economic effects? What do economists say?
Yeah, so there was a good note from Capital Economics this afternoon, quickly in response to the Japan and South Korea ones, that made an important point here, which is that these are the sort of reciprocal duties which don't apply to certain sectors, autos being a huge one. Obviously, South Korea and Japan are big auto exporters to the U.S. Pharmaceuticals and forthcoming electronics tariffs as well would be outside of these. So their calculation is about half of these two countries' exports would be impacted by this. So that would go from 10 to 25%, which is a major change if Trump follows through, but the effects would be a little less than you think because these other rates are already in. I would note that auto tariffs are already at 25%, so it's not like they're low. They're already at this 25% rate that Trump announced today.
Adam, let's bring you in here as well. What do you make of these headlines?
Well, I'll actually believe these numbers when I see them. And I think Ben just made a key point, and that is that the deadline has been extended to August 1, which means I think all this is posturing. If you're looking at the market, seeing it down today and saying, oh my gosh, how terrible, the tariffs are going to be higher than we thought. No, they're not. They might be, but they're probably not going to be. This is President Trump trying to negotiate. It's the art of the deal playing out in real time. So he throws something out there that scares everybody, gets them off guard, and it's a way of effectively trying to get a better deal from our trading partners. So that's why I say I'll believe the numbers when I see them. Stay tuned, because whatever we read in the headlines now is probably not the final deal. And it's probably going to be less scary than we think, and it'll ultimately be better for the U.S. than we think.
So Adam, you don't hear headlines like this and think, okay, it's time to make moves in my portfolio.
No, I absolutely do not. In fact, I did a little bit of buying on weakness today, which is, I think, the moral of the story. In fact, if you look at where the market was back in January, February, all-time highs, and then we had all the scary tariff stuff that took us way down, in fact, down about 32% on the NASDAQ from the February high to the April low, down 32%. That was painful. And you know what? We came right back up, and there's the chart that proves it. So, if you hadn't looked at your 401k for 3 or 4 months, you'd have thought nothing happened. Whereas if you got caught up in the headlines day in, day out, and God forbid actually sold on the lows, you'd be out a lot of money.
Allie, what are we seeing and anticipating more broadly? Walk us through it.
Well, we are seeing stocks off of their session lows here. We're still seeing weakness throughout equities. NASDAQ Composite is down about 1%. The Dow Jones off about 500 points. Then the benchmark S&P 500 down about 0.9%. But again, we are well off of those session lows here. And Adam was just alluding to the fact that this is the art of the deal. And markets have largely looked through many of these trade headlines. The taco trade, Trump always chickens out. So the fact that we're seeing some pressure here maybe suggests that we could have chaos down the line when it comes to trade and tariffs, or it could be some profit taking. But overall, Wall Street analysts have said that this is a buy the dip type of market. Now, if we take a look under the hood of the NASDAQ 100, you're going to see a lot of red, but nothing stands out more than Tesla. We are down 7% today. Over the past month, we're off around 11%. And year to date, take a look at this. We are down almost 30%. Now, the moves today come as Elon Musk said he wanted to start a third political party and that he's, quote, dead serious about it. Now, this is not something that investors at Tesla really want to hear. A lot of this has been talked at and looked at as a distraction for Elon Musk at a time when his company needs him. We are seeing delivery sales come in below expectations. We are down on a year-over-year basis. And Musk being involved in government, being involved in politics, analysts say that's just taking him away from his core responsibilities at the business. We did have a note from William Blair out this morning. They downgraded shares of Tesla to market perform. And they also cited the passing of the One Big Beautiful Bill, which would remove those EV tax credits and pressure Tesla. So that is just some of the moves that we're seeing on the NASDAQ front. And I also want to take a quick look at oil because we're seeing some interesting moves there as well. We did see that surprise output increase, those production increases from OPEC Plus, but we are seeing oil trade to the upside today. This speaks to the strong demand picture that we have, although Wall Street analysts have said that heading into the back half of the year, we could see oil below $60 a barrel there, Josh.
All right, Allie, Ben, thank you both so much. Well, for more on what the latest tariff trade deals mean for investors moving forward, let's welcome in now Jeff Schulze, ClearBridge Investments Head of Economic and Market Strategy. ClearBridge Investments has over $180 billion in assets under management. Jeff, it is great to see you. So I don't know if you heard there, Jeff, we were going over today's headlines and news. Trump is laying out his tariff terms, Jeff, for Japan and South Korea and South Africa starting August 1st. How are you thinking through it, Jeff?
Well, I feel like this is a knee-jerk reaction from the markets. It's really been a one-way street when it comes to tariff news over the last 2 months. And this is a stark reminder that tariffs could be higher than what consensus expects when we get through August and September. So I think that this is the reality trying to set in. But I also think it's a little bit of profit taking off after a very large move from the lows just a couple of months ago. So even though things are going to probably be choppy over the next 3 to 4 weeks until visibility is restored, ultimately, I would be a buyer of the dip here because when looking forward to 2026, there's a lot of things to be optimistic about with the One Big Beautiful Bills, peak fiscal impulse hitting in the first half of next year, and the long-awaited Fed rate cutting cycle probably commencing sometime in the fourth quarter.
Was there any risk to you, Jeff, that maybe we were getting a bit complacent? I'd heard this argument on the show that you know, President Trump, it was figured he was going to back off. He's not serious. He'll come off the maximalist threat. But he does believe in tariffs, Jeff, and he's believed in them a long time. He believes they're a very smart, effective policy tool for revenue raising, to encourage domestic manufacturing, for national security in some cases. Were we getting too complacent?
I think we were. I think you got to think of the 10% universal tariff as the new zero. So I think that's going to go in for every country that's out there. And as we saw with the Vietnam deal, some countries are going to be paying materially higher tariffs. In Vietnam's case, that's 20%, and then 40% than anything that's suspected to be transshipped from China. So I think this pushes the expectations for the effective tariff rate higher, which may slow economic growth in the back half of the year. But again, because of those positive drivers that I just mentioned a second ago, if we do see market volatility or a sell-off deeper than what we're seeing today, strongly advise investors that have money on the sidelines to put that capital to work in the weakness that we'll likely see.
Adam, I want to bring you here in as well because investors do have questions. One of them, Jeff, is raising possible impacts to growth. What do you see?
Well, actually, I think Jeff has just made a wonderful case for something that I really feel very strongly about right now, and that is that there's a lot more to like than to fear. And so while we can always find reasons to sort of say, well, gosh, I don't know, what if this and what if that? Look, we've got the most number of people ever making the highest gross adjusted income ever, spending the most amount of money ever. That's a strong backdrop. Add to that the fact that inflation has come down, and if you look at the average of the 4 primary inflation indicators, it's about 2.4%. The target is 2%. And it was as high as 9 to 10. So inflation is coming way down. And then again, as Jeff mentioned, we've got a Fed that is likely at some point in the fall, because inflation is coming down, to lower rates. So yeah, I know that there are wars abroad. I know that there's uncertainty around China. I know there's uncertainty around tariffs. But if you add it all up, I just see far more to like than to fear.
Jeff, so Adam there, laying out why he's constructive on this market as smartly and eloquently as he always does. What would be, Jeff, though, on your wall of worry? What are concerns you think investors should have?
Well, I think the 10-year Treasury rising above 4.5% is a clear risk. When you've seen that happen, equities have not taken it very well. It's pressured valuations. And with today's price action, we're getting closer to that line in the sand. So that's going to be something to watch pretty closely. Obviously, if we see other geopolitical risks, that could cause a momentary market dislocation. But if you go back to 1950, if you look on a forward 1, 3, or 6 month basis, the markets have generally rallied on average following geopolitical events. And the last thing is the fact that the Fed may sit on their hands longer than what's currently being priced into the markets. That September rate cut is getting pushed out potentially to November or December, October or December. And if that happens, that means that some of the companies that don't have as many offsets to the tariff pressures that you're going to see may continue to struggle in this environment. And we're clearly seeing that today with small caps underperforming large caps. So there's a lot of risks out there, but when there are a lot of risks, generally speaking, that means there's opportunity.
Jeff, one concern that is raised on this show, I didn't hear you mention it, so I want to get your take, would be valuation. I don't hear folks coming on here and saying, all right, we're at nosebleed levels. I do hear the word stretched more and more often. Do you agree with that, Jeff?
I think we're stretched, but at 23.5 times forward earnings, yes, that's high, but it's only high relative to history if you go back a couple of decades. If you look at the S&P 500, for example, very high quality index, a much more growthy index than what we've seen, a much more defensive index. And these are all attributes that lend itself to higher valuations when all is said and done. And when you think about the forward-looking basis, valuations always run ahead of potential earnings growth. And when you turn the page to 2026, I talked about those positive drivers of economic momentum. One thing that I think is underappreciated is the productivity wave that's likely coming from AI investment. And I know the mega cap growth names have been the big beneficiaries of that over the last couple of years. But as this technology is broadly adopted by many industries, I think a larger productivity wave could create better earnings than what's expected, ultimately creating more upside to U.S. equities, even though they may look a little stretched from a valuation perspective.
Adam, give me your Adam Johnson take on valuation. Broadly, how would you characterize it? Would you say is all the good news priced in?
No, I don't think it is. And I think the AI thing, whatever we want to call it, does create a huge productivity gain and, in theory, an earnings bump. But here are the numbers. This year, analysts think we're going to do somewhere around 275, maybe 280 in earnings for the S&P 500. Well, I think that's probably low because, as we've seen over the past 3 quarters, companies have beat on average by about 6 or 7%. So I think if you actually look past the calendar year, not to just 2025, but say the next 4 quarters, in other words, we get into 2026, I think there's probably a stretch of 4 quarters where we do $300 in earnings, maybe north of that. 310, 315. Well, with the S&P trading at like 6,200, now we're talking about a 21 multiple, less than the multiple Jeff just mentioned, 23.5 times if you stick just with the 2025 earnings. So as I look forward, and markets always look forward, I see a market that's trading probably somewhere around 20 to 21 times, depending upon how much earnings grow. And I'm okay with that, especially as rates come down.
Jeff, before we let you go, one more theme trend I want your take on would be the dollar, which we haven't hit. Higher today, Jeff, actually, but we know the trend this year. It's been weakness. How does that impact the upcoming earnings season, Jeff? I mean, it should be a tailwind for those mega caps.
Yeah, the dollar had its worst first half since the mid-1970s this year. And generally speaking, weakness in the dollar leads to stronger revenue and EPS growth with the S&P 500 by about 6 months. So this could be an underappreciated tailwind to a more resilient earnings backdrop as we move through the back half of the year, even though there are going to be areas that are going to be disrupted from tariffs who aren't able to fully pass through those price hikes to their consumers. But ultimately, if you look at earnings revisions, it bottomed in April. They've been getting better over the last couple of months. And I think the path of least resistance is higher from here, or better, for earnings revisions and the earnings picture overall.
Jeff, always great to have you on the show. Thank you for joining us, sir.
Thank you for having me.
We are just getting started here on Market Domination. Coming up, retail stocks in focus as the global trade picture starts to take shape ahead of President Trump's key trade deal deadline. We're taking a look at the best ways to be positioned within the sector in today's investor playbook. Stick around, much more Market Domination still to come. Retail stocks are in focus as the global trade picture starts to take shape ahead of President Trump's key trade deal deadline. With deal making still in flux, investors watching closely for ripple effects across the consumer space. We're navigating how to play retail names with the Yahoo Finance playbook. And joining us for more is Brian Nagel, Managing Director and Senior Analyst at Oppenheimer. Brian, it is always good to see you on the show. So, as you know, Brian, of course, today, listen, it's Trump and trade and tariffs front and center for investors. Brian, maybe to start, just big picture, Brian. I'm just curious how the many retailers you cover and know so well, Brian, how have they been navigating all this in broad strokes? Have they been, is it diversifying their sourcing, Brian? Are they sharing the cost with manufacturers? Are they raising prices for Brian and Josh? What's been their playbook?
Oh, Josh, first off, thanks for having me back on your show. Look, it's all of the above. Okay, and one thing I've noticed, so this, trade issues, trade issues have been, ongoing now for the past, say, several months. One positive I've seen is as I'm talking to my companies, I think they're getting clearer on what tools they have at their disposal. So just like you said, it's really a combination of factors. In a lot of cases, they're pushing back on suppliers. In other cases, they are looking at their own business model and saying, okay, look, we can take off, there's expenses we can take out here to say offset these tariffs. And then, and I want to make this point really clearly, they are raising prices, strategically lifting prices. And I think that's really started to happen here just really in the last few weeks, maybe. But it's all of the above. And that's how these retailers are at least working to mitigate the impact of these tariffs.
You also always, Brian, you have a good read on the consumer. Is the consumer, in your opinion, based on your coverage universe, what you've seen here from your companies, are they in a position to shoulder those price increases?
Well, look, it's a great question, and it depends. So I've written recently on like a company like AutoZone, which is a very strong player within the auto parts retail business. Look, AutoZone, I think, has a lot of pricing power. And so I think that's one company that, to the extent they need to, can lift prices, and you won't see much in the way of impact on unit demand. I think that's also true in other areas, maybe like home improvement. But there are categories where the consumer is much more price sensitive. So that makes it more difficult for those retailers, those brands, to raise prices. And the other point I would make on that topic, and I think to me this is the biggest worry. Okay, because we can look at it company by company and say who has pricing power, who doesn't, et cetera. But especially when you're dealing with lower, maybe middle income shoppers, more budget constrained shoppers, if you have all these price increases happening across the board, okay, it's going to come from somewhere. I think so. My biggest concern is that as brands and retailers start lifting prices, across the board, you're going to see some bigger impact, more broad impact upon consumer spending.
This may be too simple a question, Brian. If it is, I know you'll tell me. But is there some tariff level that, generally speaking, broadly speaking, retailers can actually handle? Because I've heard that argument. I've heard some folks say, listen, if it's 10%, then a CEO, a CFO can find ways to offset that.
Yeah, look, it's not a stupid question whatsoever. That's exactly, we've been trying to determine that as well. And I think, when I'm talking to these companies and I'm seeing kind of the mitigation efforts start to take hold, 10 to 20 is manageable. 10 to 20, obviously, 10 is better, right? Maybe 10 to 20. When you start getting over 10, 30, 40, that's where it gets much more challenging. But 10 to 20 seems to be manageable.
Why is Trump doing this, Brian? It's because he wants, in part, he's all about making more stuff here in the U.S. How financially tenable and viable is that for the retailers you cover?
Well, I mean, the question of why Trump's doing this, I have no idea. I mean, that's not. I guess that's not my expertise. I mean, I just follow a lot of companies that have to basically play, that have to deal with this. So let me answer the question this way. I mean, look, there's been a lot of movement in sourcing. And this went all the way back to 2018. Okay, when we had, so to say, the first set of tariffs or initial tariffs under the initial Trump presidency. And what we saw there, I mean, a big trend was a lot of movement out of China. Just in broad strokes. I mean, a lot of my companies were, prior to that point, they were sourcing 30, 50% of their goods in China. That was taken down to, call it 20. Okay, and we're seeing a further move out of China now. So, clearly these tariffs are impacting the trade relationship, if you will, the United States has with China. Okay, so that's one big factor. I mean, I've made this point before, though. I mean, the idea, at least from my perspective, of bringing manufacturing back to the United States, and I've used this word before, I'll use it on your show too, it's laughable. It's just not going to happen. I mean, it's you just don't have the labor in the United States here. In order to build up any significant manufacturing capacity, it would take years, maybe decades. The companies I'm talking to are saying, look, we don't want to make that investment. Because we don't know how long these tariffs will last. So if this is any effort to bring in any significant way manufacturing back to the United States, to me, that's a non-starter, right? But I think we have definitely seen sourcing shift from one country to another, and I think the biggest victim in that has been China.
Let's end here, Brian, with some picks. Against this backdrop, right, you got to tell your clients what to do with their money. Let's talk about Nike. Why is Nike a buy here, Brian?
Well, look, I mean, Nike clearly sources a lot of product overseas, right? I'm saying this somewhat facetiously. I mean, it's pretty much everything. It sources everything. But I mean, the one big advantage Nike has here from a sourcing perspective is they do have pricing power. And especially now with the company much more focused on innovative products. So, I mean, as they introduce the new best shoe, they have the ability to raise prices on that. So I think the point I'm making with the Nike, I think fundamentally they do have pricing power. The innovation is really kicking up there, and frankly, I think the stock is cheap relative to what that company can earn.
Final question, Brian. I just got to get this in. Why is Lowe's a buy, but Home Depot isn't?
Yeah, so it's my way. Look, I followed the home improvement sector for years. I fundamentally like both names. They're very, very similar. By having, like you said, Josh, by the buy on Lowe's and the hold on Home Depot, it's my way of saying to our clients, look, if you want to wait this out, if you want to play this while housing dynamics are still weak, and I expect them to stay weak for a while, I think Lowe's is the better play. And there's really two reasons. You have more operational slack within that business model. Marvin Ellison has done a phenomenal job as CEO there. I think he still has more room to continue to improve that business model. So that's more like the internal opportunity. And then, real simplistically, I mean, Lowe's has stayed cheap. And relative to Home Depot, it's as cheap as it's ever been, basically. And I think that discounted valuation is unwarranted here.
Brian, always good to see you, my friend. We appreciate your time and those picks.
Nice seeing you. I appreciate it.
Tariffs and trade deals dominating the headlines on Monday, with President Trump issuing tariff letters to multiple countries. As global negotiations continue, businesses are navigating rising uncertainty and preparing for potential fallout from disrupted trade flows. For more, we're bringing in now John Kaplan, CEO of Payoneer, and Yahoo Finance's Julie Hyman. Welcome to you both. John, I will start with you. You got a lot of customers all over the world. Maybe start high level, e-commerce growth. What are the trends you are seeing around the world? Where are the pockets of strength? Where are the weakness?
It's great to be here. So Payoneer has 2 million active customers in 190 countries and territories. They're all entrepreneurs and small business owners. Some will sell $30 million a year in volume, some 300 or some 3. And what we see is the Chinese entrepreneurs in our portfolio are incredibly resilient and the tariff environment notwithstanding, are seeking distribution in Europe, Latin America, and elsewhere while they preserve their relationships and distribution on Amazon or Walmart or Etsy or other big marketplaces. We recently did research, 8,000 respondents, global SMBs, 34% of international SMBs very concerned about the tariffs, 36% of U.S. SMBs concerned. So it's interesting, the U.S. business owners more concerned about the tariff environment than the international entrepreneurs. Most U.S. SMBs don't export. International SMBs start exporting from day one. They're global from the day when they begin. And so our data suggests that entrepreneurs are resilient, concerned, but focused on growth. I agree with an earlier guest who was talking about that this is a grand negotiation. and the world trade will continue. And so we're in the midst of that negotiation. But if you see through the negotiation, entrepreneurs and trade are focused on growth.
Well, and as you said, they have to operate even as this negotiation is going on. So as you say, as they are retaining and maintaining the U.S. relationships while looking elsewhere, are they raising their prices into the U.S. to account for the tariffs? Are they trying to increase their volumes elsewhere to make up for it? How are they managing around it?
It's a balance. So you'll see some of the merchants who sell goods into the U.S. reducing their SKU count, shedding unprofitable SKUs. They're reducing their cost of goods where their products are manufactured, squeezing margin out of the manufacturing. They're looking at price increases where there's elasticity in their value prop, where they in fact can pass on some price increase. Remember, those products that are imported from Asia are high quality, low cost goods, have a lot of margin in them, right? And so the entrepreneurs who are running those businesses are looking to continue to sell to the most incredible consumer on the planet, which is the US consumer, while diversifying to Europe and Latin America and the Middle East.
That said, your survey that you mentioned, what struck me is not just that about a third or so of the respondents are very concerned, it's that it's a rising percentage, which is interesting to me given that we seem to be getting closer to deals, maybe, with our counterparties in trade. So what do you make of that?
I think it's darkest before the dawn, right? Like we're in that final moment, and our customers are so resilient and confident about cross-border trade and optimistic about the long-term prospects. So in some ways, this uncertainty is kind of an air pocket in their operations. You know that feeling when you're on a flight and you go through that air pocket? It's terrifying for a minute, and then everything resumes back to normal.
I mean, you say they're resilient. I am curious because there was talk at the beginning when we had the most dire tariff rates, right? That this was going to put companies out of business, that they were really going to see a big drop. Have any of your clients gone out of business?
So it's interesting. We did research to ask, most of our customers are international businesses. They're all over the world. And we asked them, are you going to retreat from the US, stop selling to the US? And when tariffs were at 145%, which was effectively an embargo, then they didn't have much choice, right? It's hard to, operate a business if you don't have any ability to squeeze out profits. I don't think there's any desire for people to walk away from the U.S. consumer. They are very focused on maintaining those relationships.
I got to ask you, John, in a prior life, you did work at Alibaba. What is your take over there in terms of Chinese companies, Chinese e-commerce players? How healthy, how resilient do they look?
Yeah, our business today is really focused on Chinese exports. So we're the leader in the China market, helping Chinese businesses sell all over the globe. So 15% of our revenue comes from businesses in China that are selling not to the United States. 40% of our revenue never touches the U.S. So I can't really comment on, it's been 5 years since I've been at Alibaba. And our business is all exports, so I don't have much perspective to offer. Although I was in Shanghai about 8 weeks ago, it was vibrant, it was clean, people were spending money in the malls. It seemed pretty active from just a casual observer's perspective.
So let's get back to your business then. Back in May when you last reported earnings, you guys suspended your guidance. And as we know, there was a lot of uncertainty then. There is still some uncertainty now. What would make you say, I can give guidance for this year? What are you looking for?
So when our earnings were May 7th, it was 5 weeks after April 2nd, and we were at 145% tariff embargo. So it was prudent and responsible with investors to do what other big UPS did, Mattel did. Hey, we need some clarity here in order to provide effective guidance. We also said at the time that our Q2 would look a lot like our Q1, where we had 15% revenue growth, really solid margin expansion in the business. So we're hoping that in the next 3 weeks here, 4 weeks, this all gets resolved, and our earnings is August 5th or 6th coming around the corner, and hoping to be able to provide more clarity to people.
But it sounds like have you seen trends meaningfully change in terms of your business?
We had not seen, and I was at 2 investor conferences over the last month. At both conferences, investors were asking the right question, the one you are. We have not seen data in our business where there's negative impact from the tariff. There's uncertainty and concern, but I think what's incredible about Payoneer is we serve entrepreneurs. and small businesses, they are the fastest moving, most resilient about driving their own growth. And so we feel pretty comfortable about where our business is and how our customers are focused on growth.
So you guys report early August. We'll probably get a forecast from you.
We're looking forward to reporting in August.
Okay, that's very diplomatic. Thanks, John.
John, Julie, thank you both so much. Appreciate it. Coming up, CoreWeave stock, it's under pressure. The company announced it will acquire data center provider Core Scientific. Going to break down some of today's top trending tickers on their side. Stick around. Much more market domination still to come. Now time for some of today's trending tickers. We're going to be watching CoreWeave, Netflix, and Chime. We're going to start off with CoreWeave, which is seeing shares slide at the announcement the company would be acquiring data center provider Core Scientific for $9 billion. Barclays, one of the firms issuing thoughts on the deal, says that the marrying of these two businesses is a natural next step in CoreWeave's evolution as a company. And Adam Johnson, hot off the presses actually.
Yeah.
In my inbox, I've got a
Yeah.
note from Brent Till over
Yep.
Jefferies. He's a smart guy.
Yeah.
He likes Core Scientific. He likes CoreWeave. He says, bottom line, CoreWeave's acquisition here, it's transformative, he says. $10 billion all-stock deal, resulting, he says, sub 10% dilution, eliminates a whole $10 billion in lease obligations, unlocks a bunch of existing capacity and expansion potential. It's expected to generate about $500 million in annual cost savings by end of 27.
Well, CoreWeave is an IPO that is up, 400%.
Huge move,
Since it debuted only about 9 months ago. It's kind of become a darling because they effectively rent out space from data centers and enable you to have access to an entire AI platform. It's kind of like AI as a service, right? Which is really a cool concept when you think about it. I don't own it. I mean, clearly I missed out by not buying it because they don't generate earnings, and they will eventually. But this is a highly speculative company in the right place. They're doing this acquisition. I think it's prudent. It improves their cash flow, gets them closer to making money. But no, I don't own it.
All right, so slipping a bit today, but to your point, what a move since that public listing. All right, Netflix, meanwhile, seeing shares drop. It's after receiving a rating downgrade to hold. Price target removal from Seaport Global Securities. Analyst David Joyce said the video streaming giant needs some time before it can put new plans into action, like growing ad revenue, bundling more content, and releasing new user features. So Seaport does go down to neutral on this one. I mean, the stock has surged off that April low, and that's part of their point. Valuation, in their opinion, AJ, it's a bit of an issue.
Yeah, it's a bit of an issue. It's always been a bit of an issue. I would say the other issue is that they spend $8 to $10 billion a year on content that effectively is ephemeral, right? It's not like you make a movie or a movie series and then people keep rebuying it. No, you watch a movie one time and you're done, right? And so I've always had a hard time with the notion of a company that puts that much money, again, $8 to $10 billion, into content that disappears after a certain amount of time just because people aren't buying it anymore.
We'll see if there was Netflix scheduled to report. Mark your calendar July 17th, so we'll see what they say. Finally, shares of Chime, they're shooting up as 11 investment groups initiate coverage of that financial tech company close to a month after its IPO back in June. General consensus behind Chime seems to be the stock is a buy here. Analysts saying that a potential growth in low and middle income customers could make Chime profitable, which the company has not done over a full year. JP Morgan initiating at a $40 price target and an overweight rating says Chime cracked the code of scaling financial services as a non-bank. So, Adam, a bunch of analysts initiating coverage. It does seem like most did initiate with buys here. I saw Barclays has an overweight. Piper Sandler likes it as well, says it's well positioned to further penetrate the large market of Americans, they say, that make less than $100,000 a year. What do you think?
Well, fintech is a very hot area for attracting capital right now. I don't own this particular one. I do own SoFi. SoFi Technologies, which I was buying, got a 5 or 6, and it's up into the high teens. I think it's actually probably a $35 takeout. This is a company that was started as the first only from the ground up online bank. And they started off really doing student loans. Now that's only about 12% of their business. But the point is, and it's true of all these companies, Chime, SoFi, et cetera, if you can figure out how to loan money to high quality borrowers, and you can do so online in a friction-free kind of way, that is something that is certainly very appealing to me as a growth investor, and it's certainly appealing to people who need that product, to consumers, and that's why I think this space has attracted so much attention.
Yeah, we should know not everybody's in love with this one. Deutsche Bank, I see they did initiate with a hold.
Yep.
Macro-sensitive nature of its core user demo being flagged there, AJ. Coming up, Jabil up over 56% year to date. We're going to be joined by the company's executive VP on the other side to break down the why behind the high. Stick around. Much more market domination. That's all. Jabil stock is up over 56% year to date, and the U.S.-based global electronics manufacturing services company showing strong performance across multiple timeframes compared to major indexes like the S&P 500. And as a standout, we're highlighting Jabil in our segment, The Why Behind the High. My colleague Julie Hyman talking about Jabil's momentum with Matt Crowley. He's the executive VP of global business units at the company. Julie.
Thanks so much, Josh. And Matt, thank you so much for being here. We appreciate it. It's kind of incredible when I look at the history of this company, which was making circuit boards in the late 60s and still does, but makes a lot of other things and has grown into a huge company here. A lot of that growth now is coming from AI, which of course is the engine that's driving so much right now. You help oversee the infrastructure business there at Jabil. What has been driving that growth, which was something like 51% last quarter for the company? What's been driving it? What's going to continue to drive it?
Yeah, well, first, thanks for having me on, Julie. I really appreciate it. Absolutely, we've seen a ton of growth from AI. What I would tell you is a lot of that is due to our team. I think we have the best team in the business. We continue to execute exceptionally well for our customers, and that translates. And what it does is it builds trust over time. And in this market, with all of the increased demand that's going through the roof, customers need a supplier that they can trust. So we really feel like we've done a good job of building those relationships. We've executed, and now we're seeing a lot of the success. In addition to that, we've also built capabilities that we didn't previously have. So we've gone and done acquisitions in the transceiver space. We've done acquisitions in the liquid cooling space. We feel really good about how those are going, and we're starting to see those pay off.
And Matt, for those who are not as familiar with Jabil, talk to me about your role in this business. What exactly are you guys doing when you talk about transceivers and liquid cooling? Mm-hmm. Basically, you guys are helping build the racks that are in these data centers, right?
We do much more than that, actually. Mm-hmm. And so, traditionally, we've probably been viewed as a company that puts together a bag of parts, but in actuality, we've expanded our capabilities dramatically. So I mentioned transceivers. We made an investment to bring in silicon photonic capabilities, which is effectively the transmission of data via light. It's got a much lower latency and it requires less power. And so having that core capability will set us up for success and adding much more value over time as things like co-packaged optics become a more standard technology. At the same time, inside of the data center, whereas previously all data centers were cooled with air, they're now being cooled with liquid. So having capabilities, understanding how to move liquid throughout the data center, cool chips with liquid versus air, that's a capability that adds value well beyond putting together and assembling a server. And so we really feel like we've done a good job of bringing on capabilities that add more value for customers, and I think you're seeing that in our results.
As I mentioned, you saw that big growth year over year in this infrastructure business. If my math is right, it's about 40% plus, 44% of overall revenue last quarter. And you guys gave a projection that for the full fiscal year, that revenue will be $8.5 billion, which will be up 50%. You're also putting some money into the manufacturing capacity now as a result of this, a $500 million investment in the southeastern U.S. over the next several years. Is your constraint at this point capacity? In other words, do you have more demand than you're able to keep up with at this stage?
We do have a significant amount of demand. Regardless of that, we would still build incremental capacity because one of the biggest value props of doing business with Jabil in this market is that we are a U.S. domiciled, U.S. manufacturing company. And a number of our competitors with similar capabilities are Taiwanese or Chinese. And so as you think about AI, where it's going, the importance of AI, sovereign cloud, being and having a U.S. manufacturing partner that can help protect the IP that comes along with this technology, as well as the know-how, the process knowledge, it's incredibly important. We feel like the demand is going to just continue to grow. And so, yes, we're definitely pushing up against some capacity in the U.S. Having more capacity, we feel like, is going to be something that's going to be taken up pretty quickly.
And that'll be that site I mentioned will be the 31st site of yours in the United States. So when you talk about managing this growth that you guys have seen, how are you doing that? How has it been difficult to hire? How has that process been going? How much of your manufacturing, if you can tell us, is automated versus how much hiring and people need to run the processes? Talk me through that.
Well, I think, look, one of the biggest challenges with manufacturing this technology in the U.S. is that there aren't a whole lot of folks that go to school for it, because when they get out, the jobs aren't usually in the U.S. They've been overseas for the most part. So it is a challenge. We do have a significant amount of dollars that we put into things like training. We're trying to find the right labor in the right labor markets. And to your point, automation is absolutely a part of the story, but it's not the whole story, because at the end of the day, you have to have the best folks in the world who know how to do this, even with automation. So for us, it's really about finding the right labor pools, the right geographies inside of the U.S., and tapping into the knowledge that does exist to ensure we get the right folks on the job.
Matt, I'm also curious. I know that some proportion of your revenue is from government contracting for various things. And so we just had this big tax and spending bill passed. Are there implications from that for Jabil?
Yeah, I think there are. Jabil, Julie, is a very broad in-market reach. And so in my space, there are implications. I don't think that there are too many unfavorable ones, but we're still looking through the legislation and the implications of it. Across the broader Jabil in-market, potentially, I won't, dare to comment on exactly what those would be, but I think, either way, Jabil's in a great position to mitigate any impacts and to take advantage of any that are favorable for us.
Matt, thank you so much for taking the time. Appreciate it.
Hey, thanks. Appreciate you having me.
Take care. Josh, sending it back to you.
Thank you, Julie. Let's do a quick check of the markets as we count down to the closing bell here. Got a bit of red, Dow down about 475. Your broad gauge, the S&P 500, down about 0.9%. NASDAQ down about 0.9% as well. Just looking at the small caps, we're down about 1.6%. Got the great Adam Johnson here. What do you make of today's trade?
A little pullback, which makes sense. I mean, this thing has been on fire. And by thing, I mean this market. It's just been nonstop since the April low. So you would expect a little bit of give back. There were also the headlines that, gave people a little bit of spook about, oh, wait a minute, maybe the tariff monster is back. Don't worry, he's just trying to get a better deal. So all these headlines that say we're going to slap a 25% tariff on
it's a negotiating tactic.
Yeah, it's a negotiating
yes.
tactic. Japan and South Korea, they'll be just fine.
All right, thank you, AJ. While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.